Well, welcome back, folks. This is our weekend review for the ICT Mentorship for August 30th, 2020. All right, so we're working backwards from the lower time frame up to the daily. And I'm going to include some things that I would have normally reserved for a charter level lecture or teaching, but I just want to be able to be a little bit of an encouragement because I knew last week was a difficult week. It was difficult for me as well. But these are the environments that I warn you about. You have to know when they're likely to occur. And I've been flooded with emails asking how did I know that the week would create a seek and destroy profile? How do you as students understand the things that lead to that? So that's going to be the heart of the teaching today. I'll try not to be too wordy and lengthy in the delivery, so I'll try to keep it as concise as possible. But I want you to understand also this is something that comes along with experience. So it's not I'm going to watch this video today as a student and then therefore I'll know and anticipate every future potential seek and destroy scenario. Okay, so it's important that you still give yourself permission to learn by experience and over time, because none of you subscribe to the ICT Mentorship to be a trader for 12 months. Okay, it's not how, if you did, you made a mistake. Okay, you're subscribed here to learn a skill set to help navigate through price action. Okay, so that was the underlying reasons for you to be here if you were to be stripping it down to its barest essentials. So I'm speaking to you with that in mind. So I want you to constantly remind yourself and reaffirm it through your journal entries that you are a work in progress. You will always be a work in progress. I'm still a work in progress. There's still things that I'm trying to refine, like my exiting. I want my exit strategy to be more specific. And while I'm not as adamant about working towards that on a day-by-day basis, that still is a bucket list thing for me. Entries, I'm not too concerned about. I feel comfortable with that. Trade management, I feel comfortable with that. But execution of exits and being content with that, I'm of the opinion I'm probably never going to be fully satisfied with it, but it's always a work in progress. So when we have lessons like today, I'm going to cover some things like commitment of traders, seasonal tendencies. I'm going to cover things that have a bearing on why I was saying what I was saying and why we have been so reserved in the past week. So we're looking at the dollar index. This is our 15-minute time frame. Obviously, you can see on Thursday we had the result of Powell, the Jackson Hole Symposium, and also the employment numbers. So all of that were a perfect storm. But the main reason for all of this was the Powell comments about how the relationship to where we are today in terms of the economy and where it's heading and the Fed's comfort, okay, or contentment with how it is progressing. So they're allowing to see the dollar be met with inflation, and they feel that that is the most appropriate action. So initially, there was all kinds of whipsaw. Anyone that was long was taken out here. Anyone that was short was taken out here. And then we went right back to the middle of the range. Now, I went into the discussion on Wednesday, the midweek review, with the idea of pressing upon you the importance of knowing that this is low probability. Now, it was not enough to say, well, I'm completely blind to what the market's going to do. Because if you recall, and you can go back and watch the video again, I have to co-sign. Okay, when I say that, for some of you individuals that still email me, what do I mean by that? What I'm saying is I have to put my experience on the line. Okay, very rarely do I say, I don't know. Okay, but if I'm honest, I'm going to be honest, right? So if I believe the market is pushing one direction over another, I'm going to tell you which side of the marketplace I favor. And every time we sit down, I tell you where I believe it's ultimately going. Now, that may not be the translation that you're hoping for. Okay, it may be opposing what you think. And that's why it's important for you not to abandon your personal study, but also dig into the details as to why I'm saying what I'm saying. Because I have almost 30 years behind me. And if you're here, you probably don't have 30 years behind you. And it doesn't make me perfect, but it does give me the visibility that you don't really enjoy yet, but you will given enough time. And you're going to grow faster than I did because you're learning from me how to avoid all these pitfalls like this past week. So when I tell you that there are instances in the marketplace where it's low probability and not high probability, that's an area or a environment in the marketplace where I am comfortable, absolutely comfortable with allowing the market to trade and not be a part of it. Now, over the years, I've received a lot of emails about how do I grow comfort or become comfortable with not fearing missing of a large move or the next move. How do I compete with that? Well, I know that there are certain times in the marketplace that I don't want to be there because I'm more prone to be incorrect. Okay, and I don't want to deduce it to right or wrong because I don't want you thinking about it, trading in the context of being right or wrong. You want to be operating in an area that is favoring probability and removing yourself from risk when it's more likely to be adversarial. Okay, in other words, if the market is not specifically aiming for one direction over another and that it's highly likely to go higher or lower to a specific level for liquidity, then I deem that as low probability. It does not mean that the market's going sideways or it isn't going to move. It just means that I'm unwilling to participate in that move, or most likely unwilling to participate in that. Okay, so with that said, and in the context that I'm trying to make sure you're aware of, because in the past, we've had individuals in this mentorship that are highly cynical. They want black and white. They want yes or no. They want it binary to the smallest detail. There are times when my methods are just like that, and that is high probability. But when the environments are not high probability, then you're inviting the likelihood of private interpretation. Okay, where I think it might do this, but I'm going to go with this, and I got a gut feeling. Okay, and as a trader with many bad habits that were formed in my early years, I still wrestle with that because I still remember instances where my gut that told me to do this or do that because I've won money in the past doing similar things. I still have to wrestle with that. And the way I combat that is, okay, what are the protocols I'm supposed to be following? There have to be rules. If there are no rules, everyone's going to cross the center line in their car and get head-on collisions. So you have to follow a minimal list of things that are going to keep you navigating towards your destination. There are always going to be detours. There's always going to be things that's going to create delays. Okay, and as long as you're still working towards that progression of aiming for your destination or your target or your career's goal, that may be retirement early, that may be a specific dollar amount that reaches affluence in your mindset, whatever that might be, or just carving out a consistent replacement of your income from your job. Every day isn't going to be a victory. It's not. But every day is going to be a pursuit of that victory. And you have to identify, and this is what the heart of this mentorship is, you need to identify where you're likely to crash and burn. If you don't have a mentor, if you don't have an understanding of where those periods are, you're going to burn out. You're going to do things emotionally. You're going to succumb to the psychological effects of feeling like you have to do something all the time. when you don't. You have to give your permission early on in your development that you do not have to be perfect, that you do not have to be trading every day, and you don't have to know every single price move that's coming. No one, including me, has an absolute assurity of what is going to happen next. I have a process that reduces it to a high probability environment, and when it's in high probability, I'm in that 90% bracket. But I'm not 90% bracket level when periods of the marketplace are like what we're going to discuss today. So I want you to really appreciate the transparency I'm offering here, because I was really reserved this week. I didn't do a whole lot of things that would have normally put me in trades and executing a lot. I worked a lot with my sons and gave them reasons why they should not be in the marketplace, and we worked with specific drills, and they saw the pain of trying to force setups in this environment. While it's not important for you to see what they were doing, it's important for you to understand that they, just like you, maybe were pushing this week for certain things to unfold a certain way, and you encountered that adversity. It wasn't easy. It wasn't low-hanging fruit. It wasn't that just relax and let it happen environment. And that's what I'm trying to cultivate in your understanding, is that you have to be receptive to that when I tell you this is a time when we sit still. This is a time when it's low probability. Because if you listen to me in those environments, it's not going to be a market that goes sideways and doesn't have any events or price action swings. It's an environment that we are respecting the level of risk much higher than that of what we would do in high probability environments. Not to say that there's an absence of risk in high probability, because there's always risk, but there's more uncertainty, and because of the uncertainty, the parameters increase exponentially in the realm of risk in environments like we're going to discuss now. Okay, so the heart of this teaching is to get to how I'm able to see it, and you'll see environments when we go into another one in the future. I'll tell you these are the same, and you'll see these signatures repeat themselves. So I want you to make sure in your journal you want to create an area for framing low probability market environments. Okay, and right away, some of you are like, why would I waste any time with that? Especially the new folks. I'm here to learn how to trade high probability. The only way you're going to really understand and appreciate high probability environments in the marketplace is to know with a great deal of detail what low probability environments look like and how to anticipate them. It's not a watch one time video. It's a video where you're writing down notes. So if you're driving, if you're listening to this lecture at a time when you're just really not 100% dialed in and you're not really making notations in your notes, reserve this video for a time where you can do that, because it's going to be rich with things that are timeless. They're going to repeat in the future. When these things occur, then you understand 80% of the time when I'm shifting from high probability and I'm executing and engaging to, okay, I'm dialing back my measure of participation, anticipation, and my expectations just completely move to neutral. I don't care if it goes to where I ultimately think it's going to go. As you'll see in the video, and going back to midweek review, it has traded like I said, but also like I stated then, I'm not actively participating because it's low probability. So that answers, hopefully, and at least in my opinion, it has answered the question I get a lot, is how do I answer the wrestling internally about fearing a missing of moves? Well, I don't fear missing a move when I'm in high probability, because usually I'm in there getting those moves. But when it's in a area like this past week where it's low probability, I'm comfortable and anticipating that I'm probably not going to see what I would rather expect in price to unfold. It might not do that. And whereas it may feel a little bit more painful through pride, because I still wrestle with that. When I'm wrong in high probability environments, those tend to pinch because I have high expectations of myself. And I'm not saying that you should, because I'm your mentor, feel that way. I have bad habits that I still wrestle with. There are demons that I wrestle with from the 90s when I first started. They still creep up into my thinking, and I have to engage them and conquer them with the processes that I put in place. That's how I beat them. That's how I beat that fear of missing out. And what if I'm wrong? And if I am wrong, how do I combat that? And maybe some of you probably hurt yourself this past week by not listening and just still engaging and taking the same amount of risk, or maybe over trading because you did something wrong, you hurried up, tried to fix it, and you just made it worse. So all those things I'm gonna really try to tackle in this lesson. Now, I already know that there's no way I could possibly do it in a 30-minute video or so, or not even a couple-hour video, because there's so many facets to it. But the main thing is, I want you to take away from this lesson is identifying when conditions change and shift from high probability to low probability. And when low probability environments exist and they're active at the moment when you're sitting in front of your charts, those are the times when you have to give yourself ample permission to just not know it. Don't think that you're going to be right. Be pleasantly surprised if you are, but when you're not, notice the transition in mindset. You're not holding yourself to a degree of perfection, which is impossible. You're never going to reach that. But if you have mastered your mindset over what you're doing and what you're looking for, because these charts are going to tell you whatever you want them to. Some of you weren't prepared to hear that. I'll say it again. These charts will speak to you with the sweetest of words when you want them to. But they may be telling you the opposite story. They may be warning you of an impending event that may be harmful to you. But like a siren singing to a sailor in a distance, they sailed to it and they crashed themselves on the rocks. You have to be aware of where these instances are going to plague your trading. So again, in your journal, make an area for framing low probability market environments. Okay. If you do that every time we talk on this topic, and any observations that you find in your own studies or anything that may creep in through my commentaries, because I'll mention certain things, and I've mentioned them in the past in other lectures. And this is why going through the mentorship videos again, cycling through, every time you go through them and you get caught up, go back through it again. And you're going to get more information that you didn't get the first time, because now you have more experiences with me and the marketplace. And then those lessons that went over your head the first time, they've always been in the commentary, but you're not picking them out because you don't feel that they're salient to your development at that moment. You're looking for order blocks and breakers and mitigation blocks and things like that, and daily bias. And once you finally work all those areas out and you feel like, okay, well, I've answered majority of my own questions through going through the process of the mentorship. Now let me go back through, and then all of a sudden you'll start learning things that were always intended for you to pick up. But because I understand what the process of development is and how you're going to go through this, I'm already anticipating your questions. I've already anticipated the problem areas. The new folks always struggle with that. They think that there's no way that I could know that. But human nature is the same. And I know that the pace at which I deliver the content, it may not be as fast as you want, but faster doesn't get you here faster. Faster delivery of the content just bogs you down with more information because you haven't spent enough time working with the individual components. And that's why a lesson like this, which is rich, even right now, what I've already said, I could stop the video and say, okay, there it is. And new students won't fully appreciate what was spoken. But when they get to charter level and they've worked through practicing and maybe they're trading with live funds, what I've already said already is worth your monthly payment, because it's wisdom and managing expectations, knowing how to shift in and out of high probability, low probability. I haven't detailed that yet. That's the content of this video, but I want to lay down a foundation before we get into it. And the folks that come in here that want me to get right to it, you're missing it. This is mentorship. This is the stuff that you're really paying for, and you may not feel like that's what you went into it trying to acquire. But this is the thing. This is the thing that's missing. This is the thing that isn't taught in books. Okay? It's actually hand-holding and sitting you down saying, okay, I can teach you to buy and sell and send you on your way. I can show you an order block. I can show you when the market goes to a premium and discount. I can show you all those things, and you'll still lose money. Why? Because you're going to go into environments like we've just experienced last week, and you're going to look at things and say, okay, yeah, this is that optimal trade entry. This is that breaker. This is that bullish order block. This is that equal highs, equal lows, because it looks so easy. Everyone on YouTube's making channels about this stuff now. But they discover it's not that easy, because you have environments like this past week where if you aren't familiar with it, if you haven't had enough experience seeing these things, you're going to fall victim to it. And it may have harmed you in your own pursuits last week. And because you can't sit down and talk with me outside of an email, or we're not seeing face to face, we're not meeting in a social media setting where we can engage and express back and forth. And yes, I do like the bubble that I've created for myself, leaving Twitter and Instagram. Like I said, I'm not interested in outside opinions. I've always lived my life with, this is what I got. If you don't like it, don't listen. I don't think that anyone else is going to instill in me any more insight than I've already got. And I already know where my weaknesses are. And I'm working them out in my own due process. So it may sound, again, arrogant. It's not arrogance. I know the process that I'm successful with. You're learning it. We're proving it. There's a long history and track record of what I think is going to happen in the marketplace, and it's in the commentaries. You see it all the time. If I allow, and this is something for you to also consider if you have social media still, if I allow other people to give me their opinion about what I do or how I should do it better, I'm listening to someone that has a limited capacity, and they have no idea how much more I know and haven't taught on yet. So it's myopic for me or you to listen, which sounds like an oxymoron, because it sounds like, if you're closing your mind to new learning, then you are being foolish. Yes, when you're an infant. I'm not an infant. I've done a lot. And the level of this teaching only comes with experience. You can't go to a mentor and say, teach me a lesson that shows me how to avoid all pain. Now, my intent is to try to help you avoid the majority of painful lessons that don't need to be acquired through loss of money trading in these environments. But I know a majority of you are still going to not listen, and you're going to go through these environments, much like you probably did last week when I told you, sit still. Don't do any kind of trading. Be patient. Some of you wanted to go in there and get your own scars and say, well, I'm like ICT. I don't want you to have the painful lessons that I went through. I want you to say, you know what? ICT saved me a lot of time and pain, and I'm glad I didn't have to go through all that. That's the student mindset I want. It's not worshiping me. It's not bowing down to me, okay, or being brainwashed by me, okay? I'm trying to preserve and protect you from yourself. Because whether you feel like you are or aren't, you are very formidable. You have the ability to hold yourself back. When you can look around and know people in your family or who you work with, and these individuals, You empower them. They don't have any power to detract you, to keep you from learning this and leaving your job and becoming a success. But you worry about what their opinions are about what you're doing. You worry about their interpretation, their perception of what you're doing, and if it's a waste of time, a pipe dream. So that's why I'm happy with not being on Twitter, because there was a lot of ridiculous people out there just constantly throwing things at me, and I have a very short attention span. Like I'm like a dog chasing cars, okay? And it's very easy to get my attention. And if my attention is always distracted with idiots, then I'm wasting my time. So, and I'm saying that about the people that just aren't really subscribed to the things I teach, because they're either, in there to have fun, trolling, or really believing the things that are opposing what I teach and prove to you all. So it's important, if you have a social media account, to try to dial that back, because if you're trying to get the approval of other people, you're doing it wrong. You're absolutely doing it wrong, because you're never going to, I'm calling moves, I'm calling markets, and I'm showing entries and exits, and that still isn't enough. So again, you're never going to win everyone over, and that's why it came time for me to dial it back. So I just want to answer that question, because I got an email saying I can't engage with you like I used to with Twitter and show my appreciation. I don't need that. I don't need that attaboy. Okay, I believe what I'm doing is valuable. I believe that it's worth your time and your investment, and much more worth than what you've invested. And I'm trying to invest in you the absolute best that I have. And if I'm distracted, then I'm not going to be doing my best. Okay, so with that said, now I've laid all the foundation down. I've probably bored the socks off of most of you. Okay, and maybe some of you already skipped ahead waiting for this chart to change, and then maybe scrub back and see if I've stopped talking. But this is what if you went to college, you'd want to hear the professor talk about why certain things are the way they are, not just 1 + 1 = 2 and just walk away and accept it. Why is 1 + 1 = 2? There's a process there. That process is the algorithm. The steps you go through to arrive at that result, and you trust the information you get as a answer to the equation. The equation you're coming today with is, how did I know that we were going to have a seek and destroy environment this week? And why would it be advantageous for you to reserve your level of trading, but still find it beneficial to have levels in line, to see if they're going to check, see if they're going to trade to, and also go back through the price data in hindsight and ferret out the signatures that were there. And we're going to talk a little bit about that now. So we finally arrived. 15-minute chart, dollar index. All right. So I want you to think about what the market did here. What did it attack first? And then what did it ultimately do? I said that we were going to see higher prices in euro and cable going into the close of the week on Wednesday's video. I said that I was bearish on dollar. You have the video. I have to subscribe to one side of the marketplace. Okay, and I have to tell you what side I favor. That's what I mean when I say we're in 90% bracket. I'm not trying to beat my own drum here, because it means nothing in this particular environment, because I'm not actively trying to participate. And I want you to understand, even in these environments, we can still be quote unquote correct, but it's important for you to understand that being correct in this environment isn't always an invitation to believe that you should go in and trade and assume the risk, because it's more likely that you're going to be wrong and be stopped out. And then because you understand, because you're in the mentorship, that this is an area where I've already deemed it as low probability, you're going to wrestle with, I should have never done that, and you want to try to fix it, put a Band-Aid on it. And then it starts that loser's process where you go in and take more trades and they become more of a drawdown. And it just feeds itself. And you could blow your account out in a week like this if you don't have, well, discipline. So let's add some annotations here. And I'll put some more data here. And you can see the entire week. Here's Monday's trading all the way to Friday's close. And Thursday, we had all this whipsaw price action. And it did what initially? Took traders in short here. They're short. Where's their stop going to go? Here. What about traders that were already short? Well, their stop's going to be trailed here. So they're tripped in short. Longs that were long in here stopped out. Shorts either induced here or from here or back here. Stops would have been trailed in anywhere in here. They stopped it here or here, and then ran ultimately here, and then right back to the middle of the range. And then this is low probability. Now, I was on record stating that I'm favoring lower dollar, higher foreign currency going into Friday's close. I gave you levels to look for in the form of discount arrays. And they are here, here, and here, and then ultimately targeting below these lows. Let me put a little bit more data on there. All right. So we can see price did a repricing. Okay, so the central banks repriced below the low here. It left this area, went lower. So yes, I'm correct. Am I short dollar, long foreign currency? No, because I know the level of risk is higher now. And I'm trying to practice what I preach. So if I tell you that there's low probability, what we do is we study, we watch price action. So it keeps us engaged. So it isn't like, well, we just take off the whole week. You can, but when I take a week off of trading, it usually takes me about a day or two to get back in sync with it. So to keep myself engaged, I just say, okay, I'm allowing the market to do whatever I want it to do. But if it doesn't, I don't care, because there's no skin off my back. There's no pride at risk. There's no money at risk. There's no ego at risk. None of that. And I'm pleasantly surprised that it goes to where I think it's going to go. That's your mindset. Okay. As a developing student, that's how you should feel about it. Not, it's a, like right now, every decision you make in the marketplace feels like it is a make it or break it. This trade defines your entire career. If you're wrong, you're never going to make it. If you're right, you're going to be a millionaire next week. And I know what that feels like. I did that same stuff in the 90s. You feel like you have to put every bit of future success hinges on your next trade when it doesn't. But it will if you lose control, because that next losing trade, if you don't respect the level of risk, will set that thing in motion that starts that loser cycle, and you end up blowing out. So we can see price did trade down below this BISI. Very nicely traded through that. Came back up, respected that same level. Now, other than this imbalance here, why is price reacting here? It's having a difficulty going higher because it's respecting the things I teach you. The algorithm has repriced back below this BISI. It rebalanced here. All of this is stop running. Disregard all of this. Don't think about this at all. Forget it. Forget it even exists. Cut through all the candles. This is why we're not supply and demand. Cut through all of this and go right to the source of what the algorithm is going to remember. Okay, these are the PD arrays. So the market goes back to this level here and respects it. There's nothing here. There's nothing in here that says they should be pausing price here and going down. That's in retail logic, not in Wyckoff, not in any of that stuff. It's this imbalance that doesn't get rebalanced here because the market jumps down through it. That's not efficiently traded there. So all of these big candles, the down and the up candle right in here. Let me zoom in. Appreciate this a little bit more. All of this here and here, that is not efficient. It ran down here too fast, spent too little time, and traders were not allowed the time, ample time, to operate in the range between this candle and this candle's high and low. So inside this blue shaded area, that's the imbalance that should have been rebalancing. It doesn't rebalance there. So what has happened? Price trades back down through it again here. So now what does it become at that moment, this blue shaded area? It becomes a balanced price range. What makes it a balanced price range? The fact that we had this imbalance over here, where it runs up on one big candle, all of this imbalance here, which is really an hourly chart. You'll see it when we go to the hourly chart. You're probably saying, why is it not on here and why is it not on here? That would be refined to a 15-minute chart. But here, this is the hourly. So it is delivered on the buy side here. It's offered going higher, but it does not have efficiency that it has to find that efficiency when price trades back down through it here. So all of this, where it gapped down through it, in other words, all this action here, that was not efficiently traded. It spends a very nice 2-candle run to get down and rebalance, now offering the sell side. So in other words, think about that paint analogy on a roller. If you're painting your wall and you're inside your home, you put paint on your roller, you apply it to the wall, and you press up on the roller, you start applying paint to the wall. The first couple inches or so, the paint delivery is thick. It's ample. But as you go higher up, it starts creating little pockets where the paint isn't really applying to the wall anymore because it has lost the level of delivery. So what has to happen? You go back down with that roller to fill in those little pockets of the paint not being applied to the wall. That's what's occurring here. It's going back down. Now, between the top of that box and the low end of that box, it becomes a balanced price range. That's why you're seeing price not having willingness. It has no interest to go back above into that blue shaded area. Why? Because it's already done the work over here. It's in motion. It's going to go lower, as I subscribed to on Wednesday and said that we will see lower dollar and higher foreign currency going into Friday's close. So the market doesn't need to go back up. This isn't an imbalance that needs to be rebalanced to. You see the logic there? This has already done the rebalancing and becoming a balanced price range. So there's no requirement for price to get back up in there. In fact, if it goes back up in there, it's not good. It's actually not. That's a signature that you'll learn in the future that says this is probably not a good trade to be short in. But because it's offering resistance in here, real resistance, it's algorithmic. It's respecting the levels that I teach you in terms of BSI and SIBI. Buy side imbalance gets rebalanced too, and if it creates a SIBI in that same environment, which is what we have here, then you have a balanced price range. It's offered the buy side and the sell side. It's finished its work in this area here. So now the market, in respect to the dollar price, is likely to go lower in this environment and trade to where? Well, if you respect this low, which I don't, but there would be sell side liquidity resting below that. What we're looking at is the imbalance that resides over here. Okay. So we had buy side delivery here. That means it has to rebalance with price moving down at a later time inside this range. So it becomes a balanced price range. So when we see that occur here, the market trades back up, consequent encroachment. Where does the market have an imbalance now? It doesn't need to go back up here to get to this. See this? This area in here becomes an imbalance. This is the one that's important. Not this. This is not. It's not needing to trade back up to this level because it's already done its work. It's rebalanced. Now it's operating in the context that this is a balanced price range. It needs to seek downside. Okay, what is it reaching for? Those relative equal lows that this blue line highlights. And I'll zoom back out in a moment, but I want you to stay tight like this. So we have this high here, and now this high here. If price trades to that high, there's your order flow entry drill. To do what? You can be a seller there. Price drops down. It's leaving the blue shaded area because we had moved back up into an area of imbalance. It trades up to institutional order flow, entry drill. You can be a seller there. It's not respecting this wick. Okay, that's not what's going on. It's moving up to a period of imbalance. Now this ideally should be left open. We don't want to see that trade back up into that and rebalance from where we are right now. We don't want to see it go up here. We want to see it stay heavy and work down below that 92.10 level and accelerate down into the 91s. That's really the ideal scenario. But because we're looking at the ranges as I've outlined here and mentioned on Wednesday's video, we're seeing the respect of that range here. Now we trade up into it, yeah, but notice it's staying there and then we start to drop. We have this higher low than this, so we have a low resistance liquidity run in frame, plus we have the low resistance liquidity run for this blue line here with the higher lows on each side. That means we have sell side liquidity down here that is within striking distance. So that's the draw on liquidity where we're at right now. All right, I would favor it moving down below that and aggressively accelerating on the downside. That's what I would like to see. Now, with this said, let's go up to the hourly chart. All right, so here's the hourly chart, and you can respect the weekly range with this perspective, with the bookends here, this level, or vertical line rather, and here showing Friday. You can see we've consolidated, ran highs, lows, and then all the whipsaw, and then it moves, and now we're going to attack here. The respect of the volume imbalance on the daily chart, as I talked about a week ago, before it happened, we traded up into it here, and then we hit it again here perfectly. And then we create the Thursday. It doesn't run back up into there anymore because the volume imbalance done its job. As I mentioned, it should have. And then price is now working lower. This shaded area is that daily volume imbalance. Go out to a daily chart. And I'll zoom in. Right there. That's the volume imbalance. It's missing any body. Okay, yes, it has a little wick here, some wick into it here, but look what happens. It completely trades up into it here. And I said at that moment, we should see it going lower. So we favored downside on dollar. The signature was this volume imbalance. It's optimal trade entry. We went to a premium relative to this high and this low, and the market should drop lower. We have relative equal lows here, so it should work that low this week, if not right on the open into Sundays and Mondays trading. So when you see that, that's why we're seeing price drop like we're seeing now. And we have all of this area in here to consider for downside discount arrays. So it's your homework to go through and outline where your weekly levels are, weekly bullish order blocks, buy side imbalances that need to be rebalanced with sell side delivery. All of that needs to be studied in here on your own time. I don't want to pull it all out for you because it defeats the purpose, but just know that we're looking for lower prices. And ultimately, should this expand and gain momentum, which could easily happen as we go into the election, because there could be all kinds of things that I'm anticipating rolling into January too. We could see dollar eventually running out the 2018 lows, and that would create all kinds of market opportunities. All right, so let's go over to euro dollar now. All right, so here's the 15-minute time frame on euro, and you can see we have a low here, a second point, which is this high, and a third point down here, number 3. Look at the process in order of how the liquidity was taken. This point was taken here after this point took out all these highs. So it's this low attacked last, returned back to the middle of the range. Then ultimately price gets repriced above this high, straight line, works into a breaker, trades up into a fair value gap, and consequent encroachment. So the draw on liquidity and where we closed into the Friday's close was higher, like I mentioned on Wednesday, but I'm not participating in a long. I'm not doing it. Why? Because I'm respecting the level of risk that is in this environment. I might be wrong. So because I might be wrong with a higher degree of probability of being wrong, I'm not trying to participate, but I'm still able to see what moves are coming. But there's a balancing act as a trader that you're going to have to master with yourself. Are you willing to assume risk just because you feel like you're going to be right and you don't respect the market environments? Because if that's how you're thinking, one of two things are going to happen. One, you're going to be corrected and you're going to think like I'm teaching you, so that way you have longevity. Or you're going to be broken by the marketplace and tossed out. And there it is. You're sorted there. Okay. But to avoid that, try to learn what I'm giving you here. Even in this environment where the market trades up outside of the range, creates the high here, trades above it. So all of this reaction here, this is all clearing on both sides of liquidity. It trades above, again, the relative equal highs, which is what this level is here. We'll look at it when we go out to lower, higher time frame rather. We have an order block in here with a an hourly chart rather. This is a 15-minute chart. You'll see the 1 hour chart order block in a moment. But we have a buy side imbalance with it inside of a breaker. So that's where we're getting this reaction here. And it trades also 2 times in consequent encroachment of the fair value gap. So I would expect this to trade higher and continuously move higher into the 120s. And let's go out a little bit. Get a little bit more data here. And you can see the seek and destroy on the weekly profile. Monday's trading, Friday's close. Consolidation, really, really tight. I mentioned that we would see the 1850 liquidity taken out, and that would be the event for the week. And they did that here. Then they took it down, took out the weekly low, and then back to the middle. I'll give you Wednesday. We're bullish euro dollar, short in perception on dollar. So we're not bullish dollar, we're bearish dollar, bullish euro dollar going into Friday's close. Here's Friday's close. Okay, so it delivered like I wanted, but I'm not participating. And for some of you that are new or impulsive individuals, that probably drives you crazy. If you know you're likely to see it pan out, your skill level should be you go in here and you trade. Well, I can tell you, I have deep, deep scars, okay, that tell me that I did a lot of that kind of stuff before in this younger man, and it was painful to me. It created problems. It took a lot of money, yes, but it took a lot of confidence from me because I don't trust myself in these environments. Okay, so that's not a weakness. Okay, that's not a weakness on my part to admit that. It's wisdom. It's something that you gain over time and lots of scars. So I don't want to relive those environments. I've learned that there's times where it's better for me not to do this, but still get my satisfaction with knowing that it went where I like to see it go. And when I'm not right in that perspective, it doesn't hurt that bad. That's how I balance pride. That's how I balance fear and greed. That's how I balance fear of missing out. It's knowing when these environments are likely to cause this problem. And I haven't forgotten what causes it. I'm just going through the review part and telling you where I think it's going to go right now, going into next week. But I do have to move this on a little bit faster because we're going into the hour threshold and I don't want to go much beyond that. So the breaker here, we have the low, high, and the lower low, all the up close candles in here. That's what's going on over here. Consequent encroachment of this fair value gap. Split that in half. Bam. Body's respecting. Yes, we get wicks through it, but that's okay. We don't care about that. So the logic here was we had this low. We ran above it and traded back down. And the idea I gave you on Wednesday unfolds after the repricing begins. So right from here, Now, you can look at this and say, well, yeah, you got one of these things here, you got one of these things here, and you can justify all that. Look, if you feel like you can trade in this environment and you took a long and you made profits on that, well, great, congratulations. I was already calling it higher anyway, but I don't care to take on that risk in this environment. So if I were you and you were profitable going long on euro, then try to not look at that as skill. Not at least in this environment. Absolutely call it skill when we're in high probability areas, which I'll define before we close this video. So there's a distinction there. But try not to, fluff yourself up too much, because I did that as a younger man and I really wasn't as good as I am today. So I was a little premature in my self-praise. And I learned later on that I wasn't nowhere near as good as I thought I was in the 90s. So we have a low being taken here as shown on the 15-minute chart. We have the rejection block, which is the lowest down close here. We run through that and then sends it higher up into this imbalance. We have low resistance liquidity run framework still. It looks like it still could get up into that 119.65, 119.80 level. There's liquidity at 19.80. And then obviously the big figure 120. So that's where I think we're ultimately going to go. There are some things that you want to look at for euro pound. Okay, euro pound. I'm not going to cover here because it's too much. But euro pound looks weaker. So there still may be more upside leadership in GBP USD or cable over euro. But ultimately I think euro still has the framework to send it up above 1980. And how we trade at 1980, if we get there, indicates or will indicate likely how we get to 120. But we have the bullish order block here on the hourly chart inside the bullish breaker. Again, disregard all this, okay, because it's a stop run. So you got to go back to the context, which is here, and then we have these relative equal highs, which is lower on the right than the left. So we have very easy low resistance liquidity run framework now, because we've answered all this. We've already worked this out outside the range, and now it takes us back to what? The context that resides here with the breaker, fair value gap that's still open, and then the low resistance liquidity run framework that's here. Moving on to a daily. All right, so we have this area up here. I'll scrunch it up. And you probably hear something whistling in the background. I noticed it in the last recording. I closed my vent. The air conditioner is really, really powerful where I'm at right now. And I thought by closing it, it would allow me to not get too chilled. But by closing it, it creates that little shh sound. So I apologize. It's driving me nuts too. So I'll be mindful and try not to have it closed next time I do the recording. But right in here, we have an imbalance, and it'll probably appear on the weekly chart. Let me zoom in. And now we'll talk a little bit about what makes this low probability areas. There's your fair value gap right there. Okay. So I think it's going to draw up into that over time. How much time? I don't know, to be honest with you. But as an encouragement, let me take this stuff off for a second. As an encouragement, I want you to go back and listen to the commentaries back in April. And I said that if I was making the market, I would take it below these relative equal lows here, reprice to here, and then drive it up into eventually above these relative equal highs. And I said probably around Christmas time, we'll probably see it trading up in here. It's in your recordings. And here we are. Okay, so we had a 1,100 point pip move from here to here. That's the big move for 2020. We called it. We looked for it. We were studying it. We were actively pursuing it. I mentioned it in here also. Now, what makes this area here low probability and likely to create a seek and destroy environment? Well, the fact that we have traded to a long-term higher time frame objective. We've moved so far away from the inception of the move. It's over 1,000 points. Okay, we're outside the range that was created from here to here. We're elevated so beyond and above here. And we're approaching this level that may not even get hit. It may not get hit. I may be incorrect there. It may be not going to find a higher high than what we have here. Nothing says that it's going to create a higher high. It probably might do it, but because we're so technically overbought without having the use of indicators, if you look at the range from this high to this low, we're really back in premium. So now couple all those things together. We've already moved over 1,100 points. We already have traded to a target that we framed earlier in the year. We are in a very rich premium. Let me get this. This thing's always in the way. I don't know about you, but every time I try to put something where I want it, that little box here, it's always in the way. All right, so we are in 62, 70, and 79% retracement level. We are in 62% retracement. So we are in a premium market. We were in a premium market prior to last week when we traded up into here. And we were into it here as well. Remember, I said we have to slow down and be still. Go back and watch the recordings, folks. That's the language I was using. I wasn't, we're wildly bullish. It's going to break out. It's going to, no. It's logic. I'm giving you things that I'm teaching, but I'm giving it to you through mentorship. I'm showing you what I see in the marketplace, and then I'm going back and telling you how I use the tools to get there. It's easier for you to just trust the process when you go back and watch recordings that are old, because it's very comforting to hear we were looking for these things before it happened. So that's why I say I can do this in front of a court every day of the week. I have history. I'm not lying to anyone. I'm not misleading anyone. Everything I'm saying in the marketplace eventually comes to fruition. Very rarely does it ever not really get to it, at least from a higher time frame perspective. All right, so let me get this off here. I hear my bones cracking. All right, so this is the one element that leads to why I was saying that we're in a low probability environment, because we already moved a lot higher time frame wise. We've already hit a target, and we're rich in a premium level on a higher time frame level. And we have all this area here that it could retrace back into. Not even completely close, but just get back into this low here. And that would be, again, not high probability for longs. So that's one of the ideas. And let's go back out to a daily. And if you look at how price has worked from this low to this high that we have in place now, let me take this above. Okay, so this low to this high. This is a big move. That's a very significant move. And if we go over to the commitment of traders, we have a cash chart, which is ESY00 on barchart.com. I'm using the interactive chart feature, so that way you guys can see the same thing. And the red line is commercials. Now I want you to look at this area right here where the commercials went net long. Whenever they cross the zero line, which is this line right here, okay, that's the net sum zero. Above that, they're net long. Below it, they're net short. They transition to net long right there. Now, when I was a younger man and I watched Larry Williams teach commitment to traders, I thought as soon as it went above the zero line, that was a time to be a buyer because they're buying. No, that's not how it works. If they're transitioning from, as you see here, they were net short for a long time and then they went to net long, that actually is a signal to indicate institutional short selling, and the trend will be bearish because they're going to start doing what? They're going to be offering the buy side of liquidity as the market trades lower on long-term institutional shorts. They have to provide that liquidity. We don't see a change in their status of net long, net short until here. Okay, so around March of this year, we see them at that zero line again. But all through that, we have seen the market trade lower on euro. while at the same time the commercials have been, by this tool, net long. So it sounds like commitment traders doesn't work. Right. Then that's why they teach it the way they do. They don't want you to understand it like I'm teaching it. You want to see the transition from net long to net short by commercials on a longer term perspective, and that will give you many times the easiest interpretation of buy and sell models, okay, from an institutional perspective. So if the commercials are the banks and they're going to be the counterparty to large institutions, in these long-term trends, they're going to be offering for a long time the other side of the marketplace. So if the trend is lower that the institutions are being allowed to profit from, that liquidity that's being offered, they have to be the buyers. And that's what you're seeing, all this red line above zero. They're buying all this. Well, they're losing money. No, their positions are underwater. They're not losing money. It's their money. Over here, the market transitions to now the commercials are net short. Now they become net sellers, and they're selling and providing the liquidity to institutions that want to go long. So they are the counterparty liquidity provider to the institutions that are going bullish on euro here. So watch what happens. The whole time, euro has been rallying up. As I said earlier in the year, I said, don't think that this right here is a reason to go short. This is actually very bullish. And the whole time, they've been offering the sell side liquidity to the institutions that are buying all this run up that we outlined. Now, because of where we are at the extreme now. This is the highest it's been in the last 6 months. Go back 6 months. 6 months is something I teach you in this mentorship. So we are at a 6-month extreme right here. Now, it could trade higher. It could go into that 120. Great, wonderful. Is it high probability? No, because we have a new 6-month extreme, and they're diametrically opposed. We have already cleared our objectives on the equal highs on euro. We have moved to a premium relative to old highs and old lows. And from this high down to this low, we're really up in the range. And it doesn't say with any great deal of clarity that it's going to go above these highs before the end of the year. And we've already moved a great deal. Everybody wants to be buying euro right now. And that's the reason why I'm apprehensive. I don't want to do it. I want to be cautious. So this element, all the things I'm showing you here, is the reasons why I said that we are in a low probability environment. Now, couple that with the economic calendar of last week, and we have the weekly profile, where Thursday creates the wild whipsaw price action, but it still delivers what I outlined, higher prices in euro and lower prices in dollar. So all of this choppiness in here, okay, yes, you can look at this as framework, and it's a bullish order block here, came down, it looks like it's going to go higher. It could. It absolutely could. And if it does, great, the tools worked. But my trading is respecting the level of risk that we're in, and I don't really care to be right and profitable at this stage because I've been right and profitable all through here. I've been right and profitable all through here. Okay, so it's context. Okay, it's context. All right, so let's move over into cable. We'll work our way down from daily into the lower time frames for that pair. All right, so we have absolutely cleared the relative equal highs in here. So we have the consequent encroachment of this candle's wick. So midpoint of that, basically almost this high. It's still an objective. We traded to this level. This is all chop and chop. I said we're not done. I still think this is going to go higher, and it has. Remember, go back and watch the recordings here. I said it's going to go down here, likely not fill this in. It would go just below this candle's low. It did, and then I'd say I would run prices from here. If I was making cable's price, if I was making the market for it, I would reprice from here, run these equal highs, then ultimately take it up into here. Again, before Christmas. Here we are. It's not even September yet, and it did it. So, just like I outlined on the euro, because we have moved so much and we are entering uncertainty with the election year, all of the COVID-19 stuff. I think everything's going to start ramping up even more. The level of risk that is in the marketplace right now has never been as high as it is. And I want you to understand what I just said. The level of risk that is right now in all markets has never been as high as it is right now. And that should be sobering to you. That's why I'm not pushing hard, because I know something is coming that is going to be impossible to profit from. Now, after that event, just like on Thursday, after that event takes place and the board gets cleared, then I will very gingerly go over there and pick up that knife that has fallen. I'm not trying to catch a dagger. I'm going to wait for it to fall, stop quivering, and then I'll gingerly go over there and pick it up. Not trying to get cut. I have been hurt, and it would be just like Murphy's Law for me to be at the height of my career and then go in this environment and get smashed. I'm not trying to do that. So I am really respecting the level of risk throughout the rest of this year. I'm not saying I'm not trading at all. I'm just saying that, man, I am way, way, way lower in my participation than I've ever been in my trading. Like, it's like next to not doing it at all. So because of that uncertainty, I really want you to understand that while you're in mentorship, you should not be in live trading. Because imagine this. You think you see something. You want to engage in the price action. And then a swan event, a black swan event, is something that nobody sees coming, but we do. It's coming. I don't know where it's going to occur. I think it's going to happen in this pair. I just don't trust this pair. Now, that's not a knock against the people that live in the United Kingdom. I just feel like this pair has something going on. And I don't know how to articulate it. And I don't know what it's going to look like. I don't trust it. Okay? So, and it may be the catalyst that sets all the other markets in, whipsaw volatility, and where we can see a couple 100-point pips moves instantly. That's what can happen. Like, you can't protect yourself from that type of move. Okay? Your stop losses don't work in those environments. Again, you probably aren't prepared to hear that either. Just because you have your stop loss order in there, if the market gaps down 300 pips, it can't do that. Well, you haven't been around long enough. It has. It can, and it will. Your stop loss will get triggered 300 pips below. If you're long, if it drops down and gaps down 350, 500 pips, that's where you get stopped out at, not at your price. A lot of people don't realize that when they first come into this industry. Your stop loss is a hypothetical best case scenario exit strategy. That's not an absolute exit strategy where it's going to happen at that price. You are at the mercy of liquidity. And if the market gaps through your stop, it is what it is. And you suffer that damage. And the broker will be sitting there waiting for that fund to be put in the account if you don't have it. Scary, I know. And that's why I'm trying to get your attention, because some of you are just going in here with this Yahoo mentality, and now's not the time to be doing that. I don't want to sound conspiracy theorist. I don't want to sound like a crackpot. And for some of you, even though you respect the mentorship level stuff, you don't like my conversations about this stuff. And I'm telling you, if you never listen to me again, please listen to me on this one. Don't be in here driving risk, because it will burn you. And imagine you lose your account. You're not going to probably want to finish the mentorship, and you probably will be damaged financially to a degree that you won't be able to trade for a while, if at all, ever. That's what we're going into. That's the type of thing I'm expecting. So take that with whatever grain of salt you want to apply to it. But I'm telling you, I'm doing it with my own personal funds. I'm not trying to push it. I don't want to be in here giving up net worth. Not because I want to look smart for you or anyone else on the internet. So I think we're ultimately likely to continue higher, still aiming for here. It should not trade back down through the mean threshold of this down close candle. It can come back down in and touch this candle's high, but it would be better not to. Okay, so we want to see it expand. I don't like the fact that we closed right on the highs of last week, but we were looking for that anyway. But for a continuation, we've already cleared, like I said, we've cleared these highs, which was our target in the early part of the year, and this was that imbalance we traded down into. I said if I was making the market, I would trade it from here. Don't rebalance, because everybody's expecting that. I even had members in our mentorship, and this is not to make you feel bad, but people were saying, this is obvious, it's going to go down here and close this in. How obvious does it look now? Again, that's mentorship. You have to listen to the things I'm warning you about and study the things I'm pointing your attention to. If you don't do that, you're not being mentored. You're just spectating with my videos, and you're not learning. You're not being taught. So we have an imbalance up in here. Let me show you that on a weekly chart. Right here. And that would be above this high. So should we get expansion on the upside still, that would be as far as I would like to see it trade, probably by the end of the year. If it goes through that, we have relative equal highs here. That might not be 2020. That might be something 2021. But it depends. It depends on how much volatility comes in the marketplace. It could be an event that takes us and runs right on up there and clears that. And mark this in the video, put this in your notes where I just said that. The Swan event might be this exact move here where the dollar crashes and cable just rams right above the 140, what is that, 144, we'll call it 143.80 to 144, maybe in as far as 145. That's the type of event I'm thinking. Like I can't really frame it right now, but that's what I'm thinking the Bank of England's going to do. Just stick it in there and twist the knife. Okay, that's what I think is going to happen. All right, let's drop into an hourly chart and bring this video to a close. All right, so we had similar effect with and I'll look at it again on the 15-minute chart on Thursday's price action. We were going to run these highs. I mentioned that on Wednesday's video, and we had buy side imbalance, sell side inefficiency here, consequent encroachment. This low, it runs low first, clears these highs, aggressively runs deeper, clears this low here, so both sides of the marketplace are out. Then and only then is the market allowed to trade above those relative equal highs. We stopped just at it and then traded through it later on. And again, the levels are up there in terms of an hourly perspective. 15-minute time frame. Low after dropping, so shorts have stops here, or new shorts are entered in by induction. Rallies higher, clears the shorts, trips buyers in. Their stop below here is triggered as well. So that we've cleared the board. Powell's comments, everything here, cleared both sides. Low probability. The market, I was already co-signed, higher on the close on Friday on cable and euro, lower on the close on Friday for dollar. Repricing. What's it repricing? It's taking the market completely out of the range above this high, because people see this as a indication that it's bearish. It was rejected. Price is higher. Once it gets outside the range of this high, okay, it no longer is a factor, right? So what do we do now? We take our price action study to what is in the marketplace. Where's the context? So we have this price move. It trades down, clears sell side liquidity, order block, reclaimed, fair value gap. Ooh, see that? Then we have proof that it wants to go higher. Fair value gap, bullish order block, trades down into it here. New York session. Rally. If we look at a 5-minute chart on Friday, you can see that relative equal highs. That's what this level is here. We have price trade above, come back down right in here. What time of day is that? 10 o'clock in the morning, and it is Friday. The likelihood of it going higher, that's the new setup that forms. I sent it on the community tab. Once we get outside the range, it's repriced. And then we can resume back to standard operating procedure, which is we have relative equal highs. The market's bullish, dollar's bearish, fair value gap, order block, rally. And there's where we closed. Okay. So in short, I've given you a lot, and it's tucked in a lot of dialogue in this video. You want to go through this video a couple times, pull out the gems, okay, because they are signatures that are going to repeat. And when we get to levels that are uncertain in terms of continuation, and we've already seen a great deal of appreciation from a low or down from an old high, and our analysis has been correct. Everybody right now wants to buy euro. Everybody wants to buy GBP. So I'm expecting them to upset that. And maybe that upsetting was on Thursday. Maybe that's the minor event that would be needed to scare long holders from taking new positions long on cable and euro and short dollar. But the framework still is what I outlined here. Higher prices euro, higher prices cable, lower prices dollar. I'm still sitting on my hands. I'm not trying to participate yet. If I see something I really like, I'll let you know. I'll draw your attention to it on the community tab and or in the forum, or obviously in the midweek review. But I believe that this lesson was worthy of what you pay for the entire month, because it's conceptual. It's pulling the real things that you learn in this mentorship. They're all those components I talked about. You learn them individually, modularly. But because I've told you what I anticipate and expect in the marketplace over the last 6 months, you've seen that unfold. I'm showing you all those elements, what I use to do that. I am not, and this is what some of you want me to do, I'm not sitting down saying, okay, I'm using this tool right now, I'm using this tool right now, I'm doing this, because there's so many of you in here that are running your own mentorships, and you're basically ripping my stuff off. So I'm not going to enable you to look smart right when it's happening. Okay, so if you're parroting me, you're only going to be parroting me for a little bit while longer, because everything changes in December of 2021. We're going to go a different direction in this mentorship. So you learn better after also it happens. I'm already co-signed. When I say things in the videos, it's there, it's record. Either I'm right or I'm wrong. And it's important for all of you, if you've had a hard week last week, go back and watch earlier commentaries. And you'll see that I'm outlining all those things. And then now today, I can show you these are the things that led to my trust in the concepts and my analysis. And it's all taught in the mentorship. But the mentorship is me showing you what it looks like before it happens with my commentary. Then going in after it happens in hindsight and showing you the tools, where they spoke to me, and what I did with it. I'm telling you why I'm making those decisions with the tools. I'm not creating something new. I'm not bringing in something completely alien to anyone that's gone through the entire mentorship core content. Every charter member is nodding their head right now. Yeah, all that stuff you just talked about, that's in core content. So I didn't introduce anything new. It's all taught in this. Because you may see me talk about it in a video and you watched it, you don't necessarily know what you're doing with it. And again, that's what you're paying for. You're paying for my time and energy and giving you my opinion before it happens. Where are we going next? That's price action. It's not buy here, stop here, target here. That's trading signals. I don't do that. And that's why some people come in, they see that it's not like that, and they're like, what is this? And they'll never be a trader. They'll never be a trader because they want someone to feed them. I'm giving you a fishing net. I'm not giving you a hook and putting a worm on it for you. I'm giving you a fishing net. I'm teaching you how to mend that net when there's wear and tear on it. And I'm teaching you how to cast it and where to cast it and when not to expect that net to pick anything up. If you don't appreciate that, I can't help you. But those that put the work in and know that you're a part of community here now. It's not a 1-year subscription and then that's it. Like, you are buying a seat to be with me for as long as I have energy and life in me to constantly talk about these markets. You have a gateway to me. That's what this is. It is something I wish I had, but it wasn't in existence. Nobody was willing to do this. And frankly, I don't think anyone knew what you're learning from me at any time. Everyone, like I mentioned on my previous video on YouTube, brokers approach me. Bankers approach me. Lending institutions approach me. Okay? And these are people that you would expect to know this stuff. Why are they coming to me? Because they see something that is completely alien to the retail universe. And what it is the truth. So with that, I will tell you, be very mindful of the risk going forward, okay? We're entering September. It's exciting because there's a lot of seasonal tendencies that kick off in September. And I think we'll probably get a little bit cleaner price action after we get some displacement. There's going to be some, I'd prefer a hard decline to get things really moving in the foreign currencies. But, you know, what I want and what we get is two different things, and I have to trade with what the price gives me. And I will touch base with you on Wednesday or midweek review. And until then, I wish you good luck and good trading.